in some markets, Toronto, huh? Where you had really rapid increases in prices, you could see a fall of 10%, 20%. This is what he said. Good morning, investors. Bradley here from Watson Estates, and you're listening to the largest and fastest growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcasts. Could a series of interest rate hikes coming in 2022 be the catalyst that drops housing prices in the GTA by 20%? That's the conversation that we're going to have today. According to the Toronto Real Estate Board, the realtors who are typically bullish on the housing market, we could see declines, but by how much? This is a conversation we have today on our show. As a broker and investor here in the GTA, I research this topic myself and I share it on this podcast with friends just like you. And we like to have some fun along the way. If you guys haven't been tuning in, as many haven't been tuning in, today is the grand opening, the opening ceremony for the Olympics over in China. And I kind of feel bad for the athletes. Chinese political talks are consuming the conversation. Meanwhile, the Olympic runners try to avoid eating altogether because they fast. Okay, that was a bad joke. Bad joke. We're off to a weak start here. Here we go. Here's a better one. A gymnast walks into a bar. Slam dunk. If you guys haven't already, please like the show, subscribe, and whatever it takes to keep up to date with our episodes here, you can figure out how to invest and work with us. And there's plenty of links for you on our Linktree account, whether you want to join our off-market investor list, if you want a joint venture with us as we continue to look for properties ourselves, or if you're interested in coaching, all of those fun things and more can be found on our Linktree account. Go check it out, but support the show, guys. The best way to grow is organically through shares. You can tag us on Instagram, which is at Watson Estates, whatever it takes, get the word out there. As we saw massive success in prices in the last month, so too has our show. It's unbelievable. We have thousands of downloads on an ongoing basis. On a weekly basis, we've got several thousand downloads, and it's all thanks to you guys and the love and support, being able to get reached out. We have guest requests coming from every angle, and we make sure to pick the best ones for you, and we love to have some fun. But today's episode is all about what's going on in the market and figuring out what happens next, because we have some incredible stats out from January, and we really need to begin the conversation on what happens from here, because I think with the shocking lift going up, we also might not be surprised to see things could come down, and a lot of people are saying that. So here we go. Let's start off with the market update for the January 22 stats, coming straight from your beloved Toronto Real Estate Board and coming from an article who published today, MSN.com. Toronto home sales fell. Sales have fallen 18% in January. Is that a bad thing? Those of you who follow our show know not necessarily. In fact, it actually means a tighter market is forming. But we have seen, in exact opposite to that, prices climb and listings dropped. Here's how the numbers work out, folks. Sales are up sales are down 18% from January last year. Last year, they're at just under 6,900, and now they're sitting around 5,600. Keep in mind, though, by the way, that those sales are down 18% year over year. It is the second highest January ever for volume. So we're comparing against a very hot 2021, and that will be an ongoing story from all of the months moving forward, probably at least from where I can see, at least till mid-year. I think maybe even till the end of the year, depending on where the market goes. But the reality here is, even though it's low, it's still absolutely high. But what's the real story is the number of new listings and the number of active listings, because this gives us an indication of where we're headed from here. New listings fell by more than 15%. So we have less properties coming on the market. Will that change in the springtime? Hopefully, but who knows? We're comparing all these things year over year. When you look monthly, obviously they change as well. But also in the news, active listings took an even bigger hit and they plummeted. Active listings, what's available from January of last year to January of 2022, it dropped 44%. So though we see sales down incrementally from last year, we see the amount of active listing, what's available going into February, being significantly lower than last year. To me, that says it's getting tighter, possibly, but that doesn't seem to be the message that's out there right now. In fact, there's a lot of conversation about the market turning, and that could be just what's happened in the most recent weeks. But here's what they do have to say. Supply continued to be near its all-time low. That's Darren King from National Bank of Canada. He's an economist. He said that to a bunch of investors. Here's his quote: "With the recent easing of demand and slight increase in supply, market conditions have loosened slightly compared to what? December? Compared to what? We're slightly, whatever. We're tight, but remain largely favorable to sellers." That's the key here, guys. You can compare how bad is it? Is it bad or worse? The reality is it's bad. No matter what, it's bad. It's a lose-lose situation here. The sales projection, by the way, for 2022 is lower than 2021. Treb believes a slower pace of sales and fewer homes to buy, obviously, will see 110,000 properties change hands in 2022. There's a very real possibility that could be lower depending on how long this supply pressure persists. But our X factor is interest rates. Interest rates could be the camel's back being broken by the straw or something like that. That's the analogy, right? The straw. What's the last straw? Last straw is a 0.5% interest rate hike in March, and then a series of more interest rate hikes in the next, I don't know, call it 10 months, the remainder of the year at least. Ipsos consumer polling Treb released Thursday. Here's looking at some kind of stats. I love these things because they give you different perspectives. I love looking at surveys. I love getting different perspectives and different numbers. Numbers are fun. So they released on Thursday, Ipsos, that people in the suburban 905 area code surrounding Toronto will wade into the market for the first time this year, though its research also uncovered that first-time purchasers could actually increase over last year in the 416 area. So people are going to continue to buy in the 905, but we could see an increase in the number of buyers in the 416. This is a story and why condos, 2022 is very much a year of the condos. So in other words, the action is going to be, these are in my notes, in the 416. That's what we're going to see. That'll be the shocker because we've seen activity in the 905. The 416 is what's been struggling. Those are the ones sending me DMs saying, "Bradley, are you sure condos are going to do okay?" Guys, if you're investing, get cash flow. What are you looking at condos for? But yes, condos have some way to go upwards. You'll see that in some of the numbers and ideas from our show today. But when we look at the Toronto Real Estate Board, Chief Market Analyst, Mr. Jason Mercer, here's what he says. A first-time homebuyer can only buy homes that are available at the price they can afford. And that means a condo because that's more affordable than a row home or than a single detached home. So where are those condos? Generally, they're in Toronto, right? So if you think getting into the market now is unaffordable, wait until the largest price growth happens at the bottom of the market. I mean, it's fantastic for us investors. We just sit back, we make money. If laziness was an Olympic sport, we'd come in fourth so we don't have to get up and walk to the podium. But I really feel for that low end of the market. First-time homebuyers have had it rough for some time now. Well, with what I'm seeing happening here, it's only going to get the more rough, right? Well, Treb is now saying that what we've been saying, which is it attributed the unwillingness to sell as a, quote, vicious cycle. That's what they call it, where homeowners will decide not to list because they fear they'll not be able to find another home that meets their needs. I like my term. That buyers and sellers are playing chicken, right? They're all playing chicken with one another. Nobody's looking to get out of the way because, hey, I got the house and you don't. Buyers are competing with not only stubborn sellers, but also immigrants. Yes, Ipsos found immigrants are willing to pay even more than other buyers in some segments of the market. And it's forecasting that they will have even greater home buying intentions than domestic purchasers. There is a rising interest in purchases from immigrants, and they are, listen to this, willing to pay about $100,000 more on average for a home. But they noted that many of these buyers might not hold that property for long as they will likely move up to a bigger home in a few years. They're picking them up. They're outbidding locals. A common story we've seen, but one that will continue through the rest of 2022. And this is all of this massive growth is in spite of two vacant home taxes that came in effect in January 1st of 2022. There was a 1% Toronto vacant home tax and a 1% national home tax for non-resident, non-Canadian owners. Payments for which will begin in 2023. But that wasn't enough to slow it down, right? Politicians, they're headhunting. They're going to take out those investors, but they've missed the target for years. Could be worse. Could be the US. Americans win gold every year for shooting, right? At the Olympics. Makes sense. They practice at the best schools. Oh, bada boom. Well, the next target, we're not done yet. The headhunting continues. The next target that the city of Toronto is looking at is a home speculation tax. That's right. CTV News shares with us that the Toronto City Council will consider asking the provincial government to introduce a home speculation tax. Dun, da, da, da. During a meeting this week. We're waiting to hear back what the verdict was on that, but it continues to look for new ways to rein in the city's soaring home prices. What they do is not the point. That they're doing something is the point. At least it is in my mind. It's how we saw 2017 coming from a mile away when everyone starts talking about this is too hot, when it's becoming one of the top 5 issues in our province for discussion as we lead into an election, let alone in Toronto itself. Something's got to give. And that's the point here. And hopefully that's a point that you're getting from our show today. But it is not immediately clear what form such a tax could take. However, in his original motion, Cole referenced a 50% land transfer tax that was credited with slowing the extreme increase in property values in Toronto in the 1970s. They say this: if you look at the foundation of all the policies we've adopted in terms of trying to improve the availability of housing, including affordable housing, a lot of it has been with a view to placing first the notion that people are to live in homes, and homes are for people to live. In other words, screw the investor. A house is a place for you to live. And I believe that's the right principle, but it should have been one we've taken way before all of the price increases we've experienced recently. But when the best game in town for investing is real estate, I will be there in line, making money with the best of them. Coming in 4th place with all those lazy folks out there. And that was a message, by the way, from Mayor John Tory. When we talked to TREB, Toronto Real Estate Board, what do they say about such a tax, which we saw killed real estate prices in the 1970s? They say this: TREB strongly believes that public policy targeted at the housing market should be evidence-based. In this regard, it is not clear that another speculation tax on the sale of non-principal residences will have any sustainable benefit with regard to housing affordability, and in fact could create numerous unintended consequences that would cause new challenges for homeowners, buyers, and renters. Their thought here is we need to look into this more, get research and facts on whether or not this will impact the market. My thinking is it's not even about the facts. It's not about the evidence. The point is we need to freak the hell out of local residents and people buying investment properties. This is a psychological move here. There's still a tremendous imbalance of supply and demand. That's not going to go away. This is a Band-Aid solution and one that the government is obviously willing to look at. But I understand TREB's perspective. We should be cautious. We should be careful. Easier said than done when house prices are rising like crazy, including the commissions of those damn realtors setting records on the number of sales. Those buggers. Pays for my house, though. Whether this happens or not, it shows the government is sniffing around. Toronto City Council does not have the authority to impose itself a house speculation tax, and it would need the provincial government to pass legislation putting such a tax in place. You can pass that over to Mr. Ford. I know he's getting a lot of love right now with what's going on in the truckers. Add this to his to-do list, and we'll see if the government does anything. But if a 50% home speculation tax happens, city residents would get burned. They would. Their house prices anyways. But at least we'd win a gold in the suntanning Olympics. Or would we just be bronze? TREB totals. Let's look at some of the numbers. I find there's an interesting disconnect between the HPI, the house price index, which sits right now, according to January, at 33.3%. Meanwhile, the average price sits at 28.6%. We're going to get into, by the way, the discussion for and against why prices will drop 20%. I think that's healthy and timely based on some of these numbers, don't you? But I find it interesting to see that disconnect where the value per housing type is significantly higher than the average price. What that says to me, and my speculation, we'll have to see as more numbers unravel, is that more condos are in the mix. In fact, they make up 36% of January sales. I think that's what's pulling that average number down. If you were to take a true price growth of your home in the GTA, according to all the TREB totals, we're talking 33%. That is a lot more than 28. I know it's like, 33, 28, not a big deal. Yeah, that's still an extra 5% in growth. That's not being considered because it's the year of the condos. Actually, really, it's the, I just forgot what year it is. Chinese New Year. What year is it? Oh, the tiger. It's the year of the tiger. Jeez. Bad Bradley. Married into an Asian culture and forget what year it is. But at the same time, Durham has the highest year-over-year appreciation. When we look at some of the numbers, they're unbelievable, guys. When it comes to all housing types, Durham is up year-over-year right now at 44.58%. That's unreal. Even the city of Toronto not doing too bad, right? We're sitting just under 25% overall. There's obviously breakdowns. You guys can look into those details yourself, depending on what kind of portfolio you hold. But the point is we're all making mad guap. We're all sitting back, getting rich. Those of us who own real estate. Should have listened back when COVID happened. Everyone was running for the hills, right? Well, we were here, and what were we saying? But I love to have this discussion. And at the end of the day, the investment dollars are yours to make. When we look at the Toronto low-rise, average price for a low-rise home in Toronto is going, as John Pasala says, vertical. Average price in January was $1.63 million, which is up from $1.49 last month. I'll say that again. The average price in January is $1.63, up from $1.49. Not a bad monthly return for those of you who just happen to own a house. Sales to new listing ratio is lower than last year, right? We're looking for some kind of silver lining. There's a little bit of it, but it's still very hot. The 416 has been higher than the 905, by the way, for the last 2 months. So we're starting to see the 416 outperforming the 905 in sales to new listings ratio, which is a flip from what we saw in the long stretch of the 905. But even compared to 2021, when we say it's, a little bit better, we're talking across the GTA from a 73% sales to new listing ratio to a 71% sales to new listing ratio, 60% by which is seller's market. So we are deep in seller's market territory, regardless of where you're in the 905 or the 416. We're all screwed, but at least we're screwed together. And the suburbs, by the way, is still hot. In fact, what's fascinating to me is that almost 25% of Toronto Real Estate Board agent deals were done outside the GTA. That's right. A quarter of the deals weren't even done in the GTA. They are obviously helping and encouraging that out-migration that's happening from the city. Last month, it was at 21%, but these are really new numbers that we haven't seen. A trend that has been forming in the way of sending realtors out and about. At the end of the day, there's not enough deals, right? We're fighting one agent for every 59 people in the GTA. Well, we'll go out there and shed our love across this great province. When we look at the rental market, Live.rent, thank you. They sent rental market stats to my inbox, and they sent me a link. I'll share it as well in the notes, as we always do. But here are some of the key takeaways for the rental market. You guys aren't getting off the hook. No. Our prediction for rental increases is well underway. The GTA average rent for an unfurnished one-bedroom unit has soared to above its December highs. It's now at $1,790 going into February. And the average rental price in Toronto for unfurnished one-bedroom unit is 4.57% from last month. From last month, guys, 4.5% increase in a month. While furnished units saw a 5.02% increase in a month. The highest average rent for an unfurnished one-bedroom unit is actually, believe it or not, in Etobicoke. We'll talk about why it's a great place to lay your head down in Etobicoke in a minute. But they're sitting for rent at $21.45, which is a significant 22.23% increase from last month. 22% increase from last month. I wonder how many units were rented out there, but who cares? We don't look below the surface. We take the highlights and we just run with them. We go for clickbait, baby. When I look at Zealand, he posted and he's been tracking what's been going on. And when I look overall, the models for total inventory of GTA rentals, it seems to be relatively stable, but it is slowly but surely tightening. It has been so since April of 2021. As rent climbs, the chance of renters ever getting into the housing market fades. It almost seems intentional, like Donald Trump watching the Olympics to see how high the Mexicans can pole vault. But let's discuss. This is interesting. Let's discuss the power of 1 month. Maybe you've heard it so far, but we're going to really get into this. My prediction going into 2022, as you guys know, those of you who've even been listening to our show for a month or less, was that prices would rise 10 to 12%. I've even had people message me, I'm really watching to check your numbers. Well, guess what? I'm already right. 1 month later. That's right, 10 to 12%. Median price of a low-rise house in Toronto area in January 2022 was $855,000. Sounds nice. January 2021, 1.1 million, and January 2022, 1.45 million. That's over $350,000. That's crazy. The median price in January is up 10% since December, since last month. Yes, 10% growth in 1 month. There you go. Hit those numbers. Easy. Check. Cash your check. Now we got to go on to some new and improved predictions, which is maybe what we're doing here today. We're formulating those thoughts, but there's also power in 1 week. If 1 month wasn't fast enough, let's talk about this. It was only a week ago on this podcast, we were talking about how Toronto was quickly catching up in value, property pricing to Vancouver. 1 week later, Toronto is officially the most expensive metro market in Canada, beating Vancouver in January. Woohoo! Gold medal, just in time. But people can't afford to live in Etobicoke, especially. But people can't afford to live in Toronto in general. But apparently, they can't afford to die either. The Star had an article, even in your death, they squeeze you out. How cemeteries have also become out of reach Toronto real estate. Here's what they say. As Toronto cemeteries are filling to the brim, prices can run up to tens of thousands of dollars for a plot, reflecting a scarcity that bereavement industry players say they've been sounding the alarms for years. Well, it just hit our ears and our wavelength here and in the media. For those with less means, whose funerals and end-of-life rituals rely on financial assistance from the city, it's increasingly meaning burials out of town. They can't afford to rent for eternity locally. Looking across Toronto, a cost estimate from Mount Pleasant Cemetery in the Moore Park area lists the price for a single lot with an upright marker as running between $27,700 to $34,800. Meanwhile, a single casket plot in Etobicoke was listed for $5,000 on Kijiji. So even though you can't afford to rent in Etobicoke, you have no choice but to die in Etobicoke. Don't know why I'm laughing. I just find these parallels to be hilarious. A rough estimate from staff said that 15 to 20% of people buried with city assistance last year were buried elsewhere. And I only expect that number will continue to go up. You can't afford to live or die in the best city in the world. And so the solution for some is let's move to the metaverse. That's right. Metaverse is becoming a conversation. Not too much here other than the fact that people are looking that way. A Smartly article. Apparently you can get a mortgage for a metaverse property, which sounds interesting to me. But after some extensive research, there's an individual here who committed to transitioning from real estate development to digital real estate development. They're selling their portfolio in Toronto because that's a bubble, and they're moving into the metaverse because opportunity sounds safe to me. Definitely safer than Toronto real estate. Man, what an amazing place we're in. Why would you go anywhere else? I didn't think Toronto would be a place that people would be fleeing from. Okay, maybe Toronto, but like the GTA, like you're getting out, like you're not just going outwards, you're leaving the world? Are we that bad? North Korea, sure. But Canada? I don't know. There's a reason nobody in North Korea ever wins the Olympics. Anyone who knows how to run, jump, or swim is in South Korea. Oh, we're uniting everybody in our disrespect today on our show. But what happens next in our market? Well, thestar.com, they have an article called Demand Isn't Going Away. And here's what they got to say. So I want to dive before. I want to give some context on what the Toronto Real Estate Board is predicting for the next year. But then I want to talk about the two counterpoints on a 20% drop. That's going to be where we're headed here in a minute. The Toronto Real Estate Board is forecasting GTA record high home prices will climb a further 12% this year to an average of 1.23 million for houses and condos. But the region already surpassed that average last month in January alone, when homes sold for about 1.4 million on average. And when you're moving at that speed, how fast does it rebound? Is it instant? As soon as they publish the result that we hit the target, it's going to come down. Is it that sudden? Or is real estate maybe a slower moving asset class? It'll be interesting to see, even if we just live off of this, oh, we're there, the slingshot is happening. It's happening. There's a 25% year-over-year increase already. In other words, we've already beat this year's price forecast according to TREB in 1 month. And so we're going to come back to that in a minute. But here's some fun facts about housing demand. Traditionally, consumers absorb rising interest rates within 2 years. If you didn't know that, as we're kind of getting this interest rate increase, we should talk about what the impact will be. Most resume their home search within 24 months, according to Jason Mercer. So we're going to see this maybe bounce where things go crazy for the next 12 months, or like there's kind of the slow, and then eventually it kind of works its way in until the 12 month where we get back to normal. That's kind of the essence of it. He noted that immigration, which has almost stopped during the early part of the pandemic, had hit record highs by the third quarter of last year. It's only going to be rising as we have high targets. That with strong regional employment will balance slowdown in demand stemming from rising borrowing costs. You can't afford it, but there is 7 billion people, trillion, billion. The metaverse might have a trillion, but we only got a billion. Ipsos polling shows that fewer people, particularly first-time buyers, expect to purchase a home this year. So less people, specifically first-time buyers, are going to be buying. Why? Freaked out by rising interest rates, and you can't afford it. Sorry. Immigration, by the way, about 1 in 10 immigrants, however, buy before they arrive, or they purchase immediately upon landing. And then with the question of the work from home, what's going to happen here? Well, they polled 800 office workers and interviewed 40 business leaders about the future of working at the office and determined, this was the final conclusion from Ipsos, working from home and hybrid home office arrangements will be the new post-pandemic normal, which in a sense is a good thing for people who ran away from the city. Maybe you can keep your job after all. But that doesn't take away from the news that's flying at us about people coming back to the city and looking for something affordable like condos, which we won't go down that route because you know where this is going. And we're going to get to the point here. We're going to get to the now what? Because Treb's number, their prediction, is already been beat. So now what? Well, here is Treb's new prediction. They're sticking to their guns, and they say prices rose 6.9% on a seasonally adjusted basis in January, the fastest monthly gain in almost 5 years. But the group says the increase won't continue. They're sticking to their prediction, saying we've hit the number. It's not going to go any higher, maybe even come down. We're going to stick to that number. Very interesting that that's what the Toronto Real Estate Board's perspective is. They don't want to be wrong too quickly. Its forecast for the year is that selling prices will average 1.23 million, implying they will flatline for a while. Flatline for quite a while. And I had a little chart here. It was really interesting to look at the prices. January saw absurd price growth. We saw November, December did pretty good. January is just off the charts, guys. You got to check out some of these articles, some of these little charts, or just don't and just hide. They're intimidating. They really are. Treb's prediction is $18,000 lower than the number we had this January for the year. So by their math, we've peaked, right? January, that's it. Does that mean prices are going to drop now? Treb needs to be careful before they put out those ads. Right? And they put on those skis before they go out and become one of those skiers. It's a slippery slope. So let's talk about, first off, the argument for a 20% crash. That's right. People are talking about a 20% crash. It's a thing. This is a BNM Bloomberg. We're talking OSFI, Ontario Superintendent of the Financial something or other institutions. Property prices in Canada are set to fall as rising interest rates bring an end to the, quote, speculative fever in the housing market, the country's banking regulator said on a podcast. This is Peter Routledge, the head of the office of OSFI. And here's what he said. In some markets, Toronto, huh? Where you had really rapid increases in prices, you could see a fall of 10%, 20%. This is what he said. His thoughts follow a recent market intelligence report from BC Real Estate Association, which posits home sales could plunge 25% once the Bank Canada kicks off its tougher monetary policy mandate. People are going to want less homes when it gets a little more expensive, maybe because of fear or whatever the reason. But Canada has emerged as one of the world's frothiest property markets for 12 consecutive years. The housing market has soared to record heights as fears of a housing bubble have grown. I mean, we've been afraid of a housing bubble for a while. Can they say it's grown? I think it's as high as you can have. It's just continued. The government has imposed an added layer of protection in the form of a stress test, ensuring new borrowers have enough income to handle higher interest payments. And don't forget, we did recently see a drop like that. And look where we are now. I'm talking in 2017. Here's what they say. Quote, you're talking peak to trough declines of 20% in those cities between 2015 and 2017. So we can absorb that volatility. So this prediction or thought that we could see a 20% drop comes with this context that it might not even be that bad, but we could see a 20% drop. And what's interesting is that this individual, the same feller, this same fart smeller, Peter Routledge, said 2 months ago when it was coming to speculative investors buying houses. Here's what he says. He says, that's a free market economy. More power to them. How fast in 2 months, the 2 months that we've seen the fastest price growth, do we jump? The regulator jump from saying, oh, it's just a free market, no big deal, to 20% drop. Bam. In other words, OSFI's predictions are as useless as a lifeguard at the Olympics. But let's look at the arguments for a 20% 20% drop not happening. Against. Pro not happening. Okay, stories.com. Here we go. So they recap the same conversation from OSFI, just how impactful will higher mortgage rates actually be when it comes to cooling the nation's scorching real estate market? Well, according to new commentary from Canada's banking regulator, home prices could drop as much as 20%, like they did in 2015 and 2017. Okay, we're caught up. Here we go. However, other industry experts don't necessarily think that the immediate price reaction will be so steep. Seems over-exaggerated. Here's a quote from John Pisalis, president of Realosophy Real Estate. The fact is, house prices usually don't plummet overnight like they do in the equities market. The housing market is pretty sluggish and pretty slow to change, especially on the way down. On the way up, it can explode, but when the market's cooling, prices tend to be pretty sticky. And that's why I think it's less likely that you're going to see a 20% decline this year. If you own an asset and it drops 5 or 10%, is that the time to sell? Or do you believe in Toronto real estate? Interesting. Quote, we're probably more likely to see a plateauing, perhaps some softening, if things cool in the second half of this year. A slight decline, but I don't know if it's going to be the magnitude of 20%. He sounds like I do. He sounds like me. I didn't expect January to be this through the roof. And I'm expecting a pretty, if you're not getting the message here, a pretty hot February and maybe even first portion of March until an announcement is actually made. That's really kicked the can down the road a lot further. And that, in a sense, has boosted my annual prediction overall. But I tend to agree that in the latter part of 2022, we will see some plateauing. Jason Mercer of Treb here, his thoughts on this. Essentially what we've seen since the early 1990s, when the Bank of Canada explicitly adopted an inflation target policy at the 2% mark, is that 24 months after the start of a rate tightening cycle, you do generally see a dip in sales, which is already kind of here. And that makes sense as people move to the sidelines as they reassess the type of home they're going to purchase, when they're going to purchase, etc. But it's generally temporary. This is history, guys. We're talking a history lesson here. That people come to terms with the rate increase, and that they can, and then this hit of affordability, they come to terms with that. And over the 2-year span, you start to see people move back into the market. So on average, you see an initial sales decline of about 11% when you start to see the rate tightening cycle as part of Bank of Canada. But when you look at the end of the 24-month period, sales have actually increased from that beginning point by about 14%. So people take a step back, they reassess the situation, and they move back into the market. They don't just give up on the purchase of a home entirely. They're just cautious. They're cautious, as we've seen. Interesting. Wherever your thoughts are on this, guys, invest accordingly. Do your thing. I hope you guys are investing for the long term, not quick flips and pre-con contract flipping in the next, 6 months to a year. Just be careful out there. Know what you're getting into. Be aware of these trends. This is why we have this show. But let me ask you a serious question, guys. Would a 20% drop in prices make our homes more affordable? Is that a solution? When immigrants are willing to drop $100,000 to get into our market, a 20% discount, in my mind, is a fart. I guess that makes it a brain fart. The latest data from Treb shows average home prices in the GTA increased 28.6% since last January alone. A 20% cut would take buyers back about 12 months in time in terms of affordability, and leaving the priciest end of the market, detached houses, still way out of reach for many. So is a 20% drop an ultimate solution? Whether or not it happens, does it really make a difference? Which is tragic to say, but guys, with all this in mind, an incremental rate increase is maybe price adjustments, regardless of what happens with price adjustments. An incremental rate increase is maybe the best thing to happen to our market in years. This could be a blessing in disguise. I think we could use a day off. I think it's about that time. Take a time out. Here are some of my closing comments, and this is a little bit, I guess, an extra bonus on our show today. I was standing in line, and I was listening to, this is near my area, actually, where I live. And I had a couple ladies were talking to each other, and I overheard the conversation. I didn't pipe in at all because it's just an unfair discussion at that point. No, but it was nice to hear locals and kind of get their feel for what's going on in the market. This is, to be honest, the most important aspect of understanding where the market is headed. Well, this young lady, she owns a townhouse, and this is what she said. She says, everything in my price range is garbage. That's what she said. That's what I heard. So today, what I'm seeing is even move-up buyers, people that have real estate for years, can no longer afford to move up. weird. And it's got me thinking, consider the fact that your detached to condo floats around 2 times the price, right? Let's say. What that says is and this has actually been even more pronounced during COVID, is that you're going to have price of the detached properties, the low rise, growing at double the pace of some of these smaller units, condos, townhouses. The gap is getting further and further, something that we maybe disregard, but I think this is a very real struggle for people that are even in the market today. The struggle to afford housing is actually climbing, and it's gotten to the move up buyer stage, right? We have first homelessness. We have affordable housing getting hit hard. We have renters getting pushed down to affordable housing that can't afford rentals. The prices are too high. And then we see the first time home buyers getting pounded and pounded and pounded. And hopefully that's where it ends. But no, now even move up buyers are stuck. There's a deep freeze across the GTA. And here, with all of these things in mind, is hoping for a bit of a thaw. So news moves quick, and we need to be flexible in our predictions. That's why I try to do this show, right? I think I'm pretty good at being flexible. If there was a competition for the world's best contortionist, I think I'd enter myself. But along the way, hopefully you guys learned some stuff, can join the conversation. Hit me up, send me a message, tag us if you're on Instagram. Guys, I'm not that hard to reach. I'm really not. I think a lot of people are intimidated that we have a big show. Dude, I am a dude. Just like you, or unless you're a female, in which case, what's up, dude? But I really do appreciate you guys supporting our show. Those of you who are ongoing and committed listeners, truly appreciate it. Hit the like button, subscribe, whatever you got to do. If you want to get some more information on partnering with us in the actual investment world and taking this thing to the real world, not the metaverse, you can join our investor list. You can join us in joint ventures. We got coaching programs to teach you guys how to be active partners, whatever the heck you want. But one of the other things that I would love to ask as well is if you are on iTunes, please, please, please take a minute, 2 minutes. Let's get really detailed here with this and leave a 5-star review and a rating on iTunes, on Apple Podcasts. I really, really do appreciate it. We have a lot of them, but that number needs to continue to go up as we continue to hold the top spot in the greatest city with the greatest listener base on this planet. I hope you guys learned some stuff, and I hope you have a wonderful weekend. Take care and keep it real.